Hello everyone, I'm Mark Zane and welcome to Zane Investment Solutions. Before we begin, please take a moment to pause this video and review the following disclaimer. Thank you for that. I'd like to welcome everyone to a new year, 2016, and hope this year is the best for you and for everyone around you. I hope you had a good Christmas and the new year has started off well, and any new year resolutions you have, you're sticking to those. So it's one thing with trading is that we have a plan and we stick with the plan regardless on what happens, and we take out the emotion. So with any new year resolution, we must make sure we stick to the plan that we agreed to do. So what we're going to do, being 2016, this is week 1 of the Forex market review, and we're going to look at the New Zealand USD as well as the Euro USD, and they're the two charts we looked at last in week 51, and we'll just see how they progressed based on what we assumed would happen in the decline in the market. However, as normal, before we progress, we'll just have a quick review of the DailyFX. As you can see, the DailyFX has a new look. It still gives you the same great features in the DailyFX calendar with all the additional features they offer on their webpage. But we're just going to have a look at the calendar today, and we'll do the same thing. We click on the drop down arrow, scroll down to our local GMT time, and we're going to be using Australian Eastern States time. And then we go ahead and we filter on only the high importance news. That way we can just see that what's the major things coming out. So we click on the filter button and we'll just look at the high importance news. So what we're going to do today is just look at the history of what's occurred. If we go back to Monday, we can see that on Monday there was a New Zealand holiday. And we click onto Tuesday and we can see all the high importance news, and we can see there was a lot of news on the euro. So we've got the Euro German CPI numbers came out. They were forecast at 0.6 and came in at 0.3, so that was worse than expected. As we progress down, we got the German unemployment numbers and the unemployment change and rate. Now the rate remained the same, but we did see a decrease in the unemployment change from -8k to -14. So it was the same as previous month. So but they were expecting it to be not as bad, but it definitely was. And then along with the Eurozone CPI numbers also came out, and they came out worse than expected. Again, they were in parallel with what they happened previous month, but they were expecting 0.4, so getting a 0.2 number less than expected. Definitely would have seen the euro decline on Tuesday, January the 5th. So with a lot of negative numbers there, we would be expecting the euro to have weakened on that day. Jumping onto Wednesday, there was another holiday, but no major news in Australian Eastern States time. Clicking on today, Thursday the 7th of January, we have some numbers that came out. The US non-manufacturing composite numbers came out. That was worse than expected. 56 predicted, 55.3 actual. And then the US Fed minutes also came out. And if you had a chance to review the US Fed minutes on the website, you would have noticed that some of the Fed committee believe that the rate hike was on the borderline of whether they should or shouldn't have done it. Now they agreed to do it, but they were still on the borderline, and they think inflation might be the big key. So based on these two numbers, we have seen a bit of a decline in the US dollar, which would have seen, if you were trading in euro, you would have seen a bit of a pullback or positive feature on that euro or even the New Zealand USD due to the decline of the US numbers. And then if we look forward to Friday, again we have nothing, and then for early hours of Saturday the 9th of January, we've got a few numbers coming out. The USD unemployment rate and the US non-farm payroll. Now the non-farm payroll number will be a very high importance number they'll be looking out for. Previously we had 211 and they're forecasting 200k. So if we can see anywhere 200k and above, that's going to bring some strength into the US dollar. But if we see a lower number than 200k, then we're definitely going to see the US dollar weaken further. So that's going to be a number we definitely want to be looking out for. So as indicated, we're going to be looking at the Euro USD and the New Zealand USD. And a couple of weeks ago, or back in week 51, 2015 of the Forex market review, we're looking at both these two charts. And the first one is the Euro on the daily chart. And what we indicated is that we were expecting a pullback of a roughly 50% fib, which it came back. And we're looking around here, we're looking at enter to go short with our stop loss up the top. And what we have noticed is it started to decline. So that's actually quite good. We predicted quite early in the piece that the market would decline. And during the quiet season over the Christmas New Year, it sort of did travel a bit sideways, but now we're starting to see a bit of a decline. Again, if we just drop in your support and resistance areas, you just quickly, you look left and you find your support and resistance areas. And how you do that is just to see where it's bounced a few times, and that's a good indication of roughly where support and resistance could be. So what we want to do now is just zoom into our charts a bit more. We did see divergence, which we're looking all the way back here. We're looking for divergence, and we did see the divergence come in. And you can see we had a higher high in price with a lower AO. And also here, higher high in price with a further low in the AO. So that was our indicator to look at going short. As well as these levels here was the 50% fib retracement area. So based on that, if we had have taken our assumption and jumped into the trade, then we definitely would be smiling now. And we're looking at getting somewhere around these levels, and we're going to have our stop losses up the top, and they've started to fall. And at the moment, they've fallen probably about 350 pips. So we definitely would probably been looking at moving our stop loss to break even at these levels. But if we wanted to just have a bit of a further pullback, we would have just jumped onto the 4-hour chart now. And obviously, what we're looking here moving forward, this is all after what we're looking at back in week 51. But again, we had the pullback. So if we believe we're going down for wave 5 on the daily, this is wave 1 back for wave 2 on the 4-hourly. So we do expect it to come back to at least a 61.8%. It has, and it's given us another indicator to go short. And we could have had another opportunity with about 150 pip stop loss. We'll already be up 200 pips, and with a profit target of about 300 to 400 pips down to the recent support areas all the way down the bottom here. So it's good to know that this example has worked very well, and probably at this stage would be sitting at our stop losses at break even, and just to make sure that we're not going to lose any further money. And we definitely would have taken a bit of a profit off at these levels here, because this was a support area as we have previously identified. Now let's jump across to the New Zealand USD. This one as well, we're looking at purchasing back in week 51 of the Forex market review. And we're indicating that if we drew a Fibonacci retracement tool back at these levels here, we'd be expecting to be pulled back to around the 51 to 50% Fibonacci retracement level. Now, as we can see, this is, we would probably assume this could be a wave 3, back for wave 4, coming down to wave 5. So if that's the case, we do expect a bit more of a pullback than the probably 50%. But whether or not we jumped in at 50% or the 61.8, we would have had our stop losses above these highs. And therefore, we got very close over the Christmas New Year break, but we wouldn't have got stopped out. So if your nerves were still in the game, you'd be in the profit now. We then jumped all the way back and we looked at the 1-hour chart. So if we scroll all the way back to these time frames, this is where we're looking for divergence. And so we were looking for higher high in price with a lower AO, and that indicates that we have divergence. So even though we had divergence, it then broke through and it started to continue on. But if we're already in the game, that's no problems. We just continue to look for divergence. If we weren't in the trade, we could then look at another opportunity, and in this case it would have been at a better price with another higher high and a lower AO. So definitely most very recent, we're talking, you know, probably back in late December, probably the 25th of December. Actually no, the 28th of December. So we're looking at probably would be the best opportunity, but we can't always get it right, but at least we were able to stay in the game by having our stop losses up at these levels up here. We can then jump down to the 4-hour chart, and we can look for another opportunity to enter the market. And as you can see, we've had a big pullback, so it hasn't really given us another indication to get back into the market. So it probably would have been a little bit difficult at this stage to get in. But definitely, if you're looking at the 1-hour chart, you would have come down and said, well, that's wave 1, a pullback for wave 2. So wave 2 is going to come back to about 61.8% fib, and it came exactly around there, which is perfect. You would have then had your stop loss above the highs, roughly about 30 pips, 25 to 30 pips, and you've made over 200 pips. So we're talking, it's a big risk to reward. I mean, you wouldn't have gone that low. You would have taken it out down here and made something like 4 times your money, but you definitely would have locked in some serious profits. And that was all because of the poor news which has occurred in the market, and that's because when everybody starts selling the stocks, such as the US 30 or the DAX or the German or even the Aussie 200, everyone wants to sell that off. So let's just have a quick look also on the USD yen. And the reason why we're looking at the USD yen is we're seeing a sharp decline on the USD yen, and that's because the yen's getting stronger. And what happens when people sell off the stock market? They buy the yen. And so when you see in the stock market fall, expect the US dollar against the yen to fall as the yen strengthens. But that's just something we want to look at, because we'll have a quick sneak preview. We look left, we can see major support area at these levels, so I wouldn't be surprised that we see a bit of a bounce higher. We have the stochastic now below 20, so we should be looking for opportunities to go short here, and divergence is your first example with a lower low in price, and in this case we need a higher AO and we have divergence. So around this area we will be looking for a buying opportunity, ready to buy it up and have our stop loss somewhere down here. So maybe risking something like 150 to 200 pips, easily going for another 250 pips. Looking left again, somewhere around these levels will be our first place. We'll be looking at taking some profits and getting out if we want to, or definitely moving our stop loss to break even. So that was our Forex market review, the first one for 2016. I hope you enjoyed it and you got some useful information, and if you managed to get into any trades just prior to Christmas, hopefully they're doing well for you now. But if you didn't and you took the break over the Christmas New Year, then you've done well, because the market generally goes sideways and it becomes very volatile, and we don't want to be in that market. But now that 2016 is here, we're gearing up, ready for a great year. I wish you all the best to your success. Take care. Bye-bye.